I'm Charlotte McLeod with the Investing News Network, and here today with me is Ronald-Peter Stoeferle, Managing Partner at Incrementum and author of the annual In Gold We Trust report. Thank you so much for being here online with me once again today.
Hi, Charlotte. Good to see you. Hope you're well.
Yes, nice to see you as well, and hope you're doing well. We're going to jump right into our questions with a big one that's really been on our audience's mind right now, which is what is going on with gold this year? It's an environment where I think many people feel there are factors that should lead to a higher gold price, and yet we've seen a decline in the first quarter of the year. So if you could start by sharing your thoughts on what we have going on there.
Yeah, well, I think it's primarily three different factors. First of all, we saw a pretty big move in 10-year yields from 0.5% in August last summer. That was exactly the point in time when we did hit an all-time high in gold. And since then, it moved up to almost 1.8%. Now it's slightly lower, but it does, from an absolute basis, that doesn't sound like a lot, but it was a big move. And actually, inflation expectations for the shorter term horizons has risen, but I think the market doesn't believe that over the longer term inflation will be a concern. So it is more of a reflation trade, and this is what we're seeing in a commodity space especially. It's more a reflation trade than the big inflation trade from my point of view. The second factor, I think, was the US dollar. Not sure if this is the beginning of a big secular bull market or a dead cat bounce. From my point of view, the dollar was extremely oversold. We saw positioning, bearish positioning at an extreme. So from my point of view, I tend to believe that it's just a correction within a secular bear market. And the third thing that I'm seeing is definitely the competition coming from Bitcoin. I think that Bitcoin, I don't regard it as a competitor or an enemy. I think both are answers to the mess that we're in, to inflationism, to high debt levels, and so on. But obviously, I think Bitcoin stole a bit of the spotlight and media recognition from gold.
Okay, we have a lot to unpack there, and I think I'll start with inflation. You mentioned maybe that in general, people are not seeing that as a big concern, but I do remember in the last In Gold We Trust report, you mentioned it would be a big theme for you for the next decade. So what are people missing about inflation right now?
Well, of course, everybody thinks it's only transitory, and this is also what central bankers keep telling us. But from my point of view, and this is not only Ronnie Stoeferle, I'm very happy that some really high profile analysts and market strategists that I really enjoy reading and talking to, like Russell Napier. We just did an interview with him, and he has been a deflationist for decades, and he's now also in the inflation camp. And I think there's quite a lot going on. I think it's, this move from deflation to inflation. This is really more like a pendulum that is swinging. It is not one exact point, one tipping point, but we're seeing that those inflationary forces are now becoming stronger than the deflationary forces. I think there's a couple of things that lead me to the conclusion that inflation will become a real concern for market participants over the next couple of years. First of all, now we are seeing not only extreme monetary interventions, monetary stimulus, but also extreme fiscal stimulus. We saw that 1.9 trillion in the US. Now the next package is coming with 3 trillion. And it is said that this is becoming something rather permanent. so I think the market is conditioned like a Pavlovian dog to more and more fiscal stimulus. This is one thing. Then we are seeing this interconnection between monetary and fiscal policy. And I think the symbolic character of Janet Yellen, who used to be the of the Federal Reserve, now being the Treasury Secretary. I think this is a very, very strong sign and a confirmation for this thesis. And it's also, you know, the former head of the ECB, Mario Draghi, now being prime minister in Italy. So we're seeing many things that confirm that that view. The next thing that I would see is that, you know, policies like MMT, like helicopter money, etc., universal basic income, they are now really a topic of the mainstream. They used to be, before COVID, there was really something for, you know, rather left-wing economists. Now it is something that is already implemented or that will be implemented sooner or later. And then I think we should not forget that already before COVID, debt levels were extremely high. Now nobody cares about debt anymore. I think fiscal conservatism and having a balanced budget, this is, you know, this is something for the baby boomers, and nobody cares about those topics anymore. And of course, the higher the debt level, the higher the desire for inflation, and the bigger the fear of deflation. So therefore, I think, you know, this rise in yields that we saw, it is rather short-lived, because we simply cannot afford significantly higher rates. That's just, you know, I think my youngest daughter could calculate that it just won't work out with higher real rates.
All right, so looking further at inflation, where do you see levels going in 2021? And maybe this is a silly question, but if it goes beyond what the Fed is looking for, what is to stop the central bank from going in and making changes to bring it back down to a lower level?
Well, the thing is, back in the old days, we had 2% as some sort of a ceiling. 2%, this was like the sign for central bankers. Okay, well, we have to reverse our policies. We have to at least consider raising rates and reducing QE, whatever. But now the Federal Reserve has moved, and this is, from my point of view, one of the biggest shifts in central bank policy of the last couple of decades, but people didn't really follow up on it because it was introduced in August. But I think this move to average inflation targeting is really a big revolution in a negative way. So basically now the Federal Reserve will have the excuse saying, well, you know, inflation rates were too low for the last couple of years. Inflation was undershooting. Now we can allow inflation to overshoot up to 3-4%, whatever, and then on average we'll achieve 2%. So therefore, I think it's, if you follow what Fed governors say, I think it's crystal clear that they are not scared of inflation at all, that they want to see significantly higher inflation rates, that they see those moves as just transitory, and you know, also because of the base effect, inflation numbers will rise going forward. But I think one additional topic, Charlotte, that we are currently working on for our upcoming In Gold We Trust report, that, by the way, will be published on 27th of May. I think it's also this demographic shift that we're seeing. Not only in China, but also in the Western world. And we shouldn't forget that the tensions between, let's say, the US and the Western world in general, and China and perhaps Russia, I think this feels a little bit like a new Cold War. and this should also be a significant driver on the inflation side. And if you have a look at the renminbi, how it developed, how it strengthened against the US dollar since May of last year, this also is another inflationary driver. So I think it's really a number of factors that are making this pendulum swing from stronger deflationary forces to overwhelmingly strong inflationary forces.
And as we go through this transition, how should investors be positioning their portfolios? What does a portfolio look like in this environment?
Well, I think, it is the big question, of course, is how your portfolio is allocated at the moment. If you're overweight real assets, if you're overweight gold, silver, commodities, commodity related stocks, perhaps real estate, and underweight bonds and inflation sensitive stocks, then you're pretty you should do pretty well. Unfortunately, the majority of investors, and especially institutional players, they aren't positioned for any inflation going forward. So a traditional 60-40 portfolio will be dramatically impacted by inflation. Now, we published a special report on inflation last December, where we crunched the numbers and analyzed which sectors do perform best in inflation, which sectors and assets do perform best in stagflation. And I think one of the main takeaways is obviously if you're concerned of inflation, you shouldn't hold too much fixed income. But also at some point, and I think this is the kind of the feel-good zone for equities. It's between 1 and roughly 2.5 or 3%, but above this feel-good zone for equities, there's tremendous headwinds kicking in for equities. And we shouldn't forget the 1970s, highly inflationary or stagflationary decade, was a terrible decade for stocks. So I think if you really expect inflation, you should be very concerned about the sector weightings. And stocks in general aren't the best inflation hedge. You really have to focus on the sector. You have to focus on the pricing power of the company, and just do your homework. And one last thing, we mentioned it. I think the age of the average investment advisor in the industry is 54 years old. So those people during their professional careers never experienced any inflationary environment. And therefore, I think that many investors will be caught at the, how do you say, at the wrong foot. And this is very interesting. We talk to asset managers from all the world, from all over the globe. And if you talk to asset managers, for example, from Turkey, from Brazil, from countries in general where inflation has always been a big concern, for them holding gold and holding commodities and holding hard currencies is just natural, because they are used to thinking about inflation, being concerned of inflation, and inflation being one of the most important drivers for the asset allocation. But if you talk to investors over here in the Western world, where we had some sort of a disinflationary environment for the last 4 decades, nobody really cares about inflation yet.
Right. Okay. So thinking about portfolios, stocks, where are you seeing opportunities in the gold stocks right now? What are you looking at there in terms of your fund?
Well, actually, we like the current environment, because we shouldn't forget that last summer, you know, everybody was super bullish on gold, and it was just, you know, if cocktail parties would have been allowed, people would have asked me for, you know, my recommendations in junior exploration stocks or whatever. Now it is completely the opposite. Nobody cares about the mining space. Nobody cares about gold, and people tend to forget that last year was the most profitable year for gold producers in history. So therefore, I think it's a nice opportunity. We had 150, I think, meetings with company management teams in the mining space, and I have to say that most of them really did a tremendous job. First of all, dealing with all the problems around COVID, then getting their balance sheets in order. They've got really pristine balance sheets. I'm seeing tremendous value in balance sheets on the mining space. There's really some cash flow monsters out there. Companies are giving back to investors in the form of rising dividends or stock buybacks. So it's really the healthiest state that I have ever seen the mining space at. We have been buying silver miners over the last couple of weeks. We've been adding to our positions in some developers that will be taken over at some point probably, but also in the large cap space and in the royalties and streaming space. I think now we are seeing really decent valuations, and you know, I don't think that the miners will decouple from the price of gold. I think this will still be the most important drivers. But from my point of view, this level of pessimism that we have seen in gold, I think this confirms that we have already seen the bottom. And I tweeted out a couple of days ago some technical points where I said, oh, okay, I think this is really the panic sell-off that you want to see close to a bottom. And therefore, I think, you know, now accumulating mining stocks is probably not the worst idea.
Right. And we should probably touch on where the gold price may go in 2021. I remember you have a pretty high long-term target, but what do you see for this year?
Well, I think, you know, my target has been around 2,300 US dollars. Is it possible in 2021 after a pretty rough start? I think it's possible. If we should see this move in real rates lower, and I think that we might see 10-year yields rising a bit further. I think the market always wants to see the big round numbers, so 2% might be a target, and then I think at some point the Federal Reserve will have to step in and introduce something like yield curve control. And this will be exactly the point in time when gold will start going significantly higher. I expect the US dollar to go lower once this is announced. And I think the market is already being prepared for it. Jay Powell wants to appear like, you know, the tough guy, who is in control of the markets. But I think at 2%, everybody will realize that the emperor has no clothes. And I think this will really be the point in time when gold will rocket higher. However, I think we are in a secular bull market. We should not forget gold was up 25% in US dollar terms last year. So we shouldn't become too greedy. This has been a tremendous year last year. Now it's cooling off a bit, but it's, you know, I'm an avid runner and I love running in the mountains, and sometimes, you know, you just have to stop a bit, take a breather, and then continue running up. And I think this is what we have seen over the last couple of months.
Right. And just as we're coming to the end a little bit, I do want to touch back on, because you mentioned it as something that is maybe taking away some of the attention from gold. But what are your thoughts on Bitcoin overall? I believe you think that gold and Bitcoin can coexist in a portfolio together. So if you could talk a little bit about that and maybe what purpose they both serve. Are they serving the same purpose, or do they have different purposes when you're holding them?
Well, from my point of view, they're both assets that have a extremely high stock to flow ratio and that are not inflatable, and their supply is rising by roughly 1.6% a year, which is significantly lower than all the monetary aggregates grow. So from my point of view, they're somewhat related. They're perhaps cousins, but we should not forget that that the risk profiles are completely different. I mean, gold has a 5,000-year track record in a, let's say, trial and error process. Market participants all over the globe, on every continent, in every religion, decided that gold is the ultimate money, while Bitcoin's track record is obviously much shorter. However, I think, you know, we've got two funds where we combine gold as well as Bitcoin. We like gold for stability and Bitcoin for convexity. And I once made the comparison between, you know, it's like comparing a car, a big SUV, a family car, which is safe, but obviously, you know, not that not that sexy and not that interesting, perhaps. And if you compare it to a Ducati motorcycle, which, you know, has a completely different acceleration, which is cool and fun to ride, but it's also, of course, more risky. You know, you can have both. The stability and the comfort as well as the fun. And from my point of view, Bitcoin is rather binary, and I think, you know, if Bitcoin will still be around in 5 or 10 years, it will be significantly higher. On the other hand, we should not forget that that now really 2020 was the first year that institutional demand came in. And then I'm seeing it really from banks all over the globe, that now, as they have a regulatory framework, they're kind of considering adding some Bitcoin to their portfolios. But this is still very, very early on. You know, we are writing about Bitcoin in our In Gold We Trust report since 2012. From my point of view, it is ridiculous that people try to frame it as the big competitor. I think you want to hold both in your portfolio, especially in this environment with huge monetary experiments, with enormous fiscal stimulus, with MMT style policies, with the highest debt levels that we ever saw in peace times. I think you just need some sort of monetary insurance in your portfolio. And I think that gold, but also Bitcoin, do the job pretty well.
Okay, very balanced. Now, just before we wrap up, I want to ask if there are any other final thoughts that you would want investors to carry with them for the next few months or the year.
Well, I think, you know, for a macro investor who knows or who cares about long-term debt cycles, so you have to be a student of monetary history. I think those topics will really be very, very relevant going forward. And it's not just Ronnie over here at Incrementum talking about the end of those long-term debt cycles. It's also people like Ray Dalio. And therefore, I'm really excited about the upcoming In Gold We Trust report, where we'll really analyze all those long-term drivers for gold, for Bitcoin, for mining stocks, and of course for fiat currencies. The report will be published on May 27th. We are really working 24/7 on the report. I got up at 4:30 in the morning today and started writing and proofreading. So we're pretty excited. And I think that if you care about those topics, it should be a pretty interesting read.
Okay, perfect. Well, we'll keep an eye out for that one. It sounds like it's going to be a great read as usual. Thank you so much for being here today to talk with me about gold.
Thank you very much, Charlotte. Always a pleasure. Take care.
You too. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Ronnie Stoeferle of Incrementum.